In this video, you're going to learn all about earnings and dividends. Companies on the stock exchange are public companies, and these companies are obligated to announce their earnings per share, or EPS, quarterly. This is calculated by the profit divided by the outstanding shares of the stock over a given quarter or year. There are three major measures of earnings: earnings before taxes, or EBT, or second, earnings before interest and taxes, or EBIT, and third, earnings before interest, taxes, appreciation, and amortization, EBITDA. Analysts will use these methods and will have an average estimate of earnings. And it's most important just to know the EPS, or earnings per share. For example, an analyst might expect a company to have an EPS of $1 per share. During the quarterly earnings season, all these companies give earnings over the span of a few weeks. This brings major volume and movement to the markets. A stock will generally go up if they beat expectations and go down if they miss expectations. However, that is not always the case. Let's go back to the example. If the company is expected to have an earnings of $1 but realizes $1.30 per share, then they surpassed their expectations and the stock will likely rise. But another significant factor is the company's expectations for the next quarter. So even if they beat earnings for this quarter, if the company announces a poor outlook for the stock, it will likely fall. In addition to earnings per share, they usually report other significant numbers such as revenue, some store sales, charge-offs, seasonal adjustments, etc. Any one of these factors can impact the movement of the stock. So just because a company beats or misses earnings does not mean that it will go up or down based off that. A lot of traders completely avoid trading earnings because of the large moves it can make. So be especially careful when you see earnings on a stock. But trading during earnings season is a significant advantage to intraday traders because earnings are typically announced during aftermarket or pre-market hours. So when the stock opens up to the regular day session, it usually brings a lot of volatility and significant market imbalances. Some people will do their research and hold stocks during an earnings announcement, but this can be very dangerous. For the most part, trading an earnings move is pretty close to gambling, as most people have no idea the outcome of a company's earnings. Most traders are only reacting to the earnings announcements, not trying to predict the report. There are some safe ways to trade earnings using option spreads, but we'll go over that later. Now, as stockholders, since you hold a portion of the company, you can receive a portion of the company's earnings. This is called a dividend. Not all stocks do dividends, but most large caps and good companies will. For example, Apple gives a dividend of 82 cents a share quarterly. So if you owned 100 of Apple, you would be paid $82 4 times a year in dividends. A lot of long-term traders take dividends into account to grow their portfolio as a whole. Dividends can be a large focus for a lot of investors. As a side note, in order for you to earn the dividend, you must own the stock a few days before the dividend. So you will not receive the dividend if you buy the stock today, knowing it's going to be giving the dividend tomorrow. Also, if you're doing options do not receive dividends. In summary, make sure you know when earnings are for certain stocks and recognize if dividends are something that you want to be investing in. And I will see you in the next video.